Welcome to Wall Street Week, the show of record for long-term investing. I'm Gary Kaminsky.
And I'm Melissa Francis. The last jobs report under President Obama is the big story on Wall Street this week. U.S. economy adding 156,000 jobs while the unemployment rate ticked up to 4.7%.
Give credit where credit is due. When President Obama took office, the unemployment rate was 7.8%. Of course, that was at the height of the Great Recession. But in less than 2 weeks, Donald Trump will be sworn in as the 45th president of the United States. And that's what companies, the economy, and the labor market are gearing up for. To today's guests, Fiera Capital U.S. Division President and CEO Ben Thompson, and David Albrycht, Newfleet Asset Management President and CIO. Dave, I'm sorry, I knew I was going to get that wrong. I'm so glad that you guys are here because I've said, Melissa, you've heard me say it on TV for 25 years, the bond market is much smarter than the stock market. So, guys, what is the bond market? And, Ben, I'll start with you. What is the bond market telling us about the economy, the labor market, and what's going to be, what the outlook is for the next year?
Sure. The bond market says the jury's out, right? I mean, the bond market had a pretty sharp sell-off after the election. December was better. We've had, the numbers today are kind of a non-event. It doesn't give us any new information. It's not an outlying number, high or low. Inside the number, there are a few components that are causing a little bit of queasiness in the bond market. But frankly, I'd say the bond market still reflects the fact that we've had a relatively weak U.S. economy. Now, there's a change in sentiment for certain. There's a change in expectations around regulation. There's a change in expectation around business friendliness. But the bond market certainly hasn't broken out of this range. I mean, we've been in a range of 1.5% to 3% for the last 5 years, and we touched 137 after Brexit. So it feels like we've come from a very, very low level. But here in the 240 to 260 range, this is not a very high 10-year bond rate. So the bond market is saying that we really don't know anything at this point, and the jury's out.
And Dave?
Yeah, I would say with the employment number, I would echo Ben's comments. But one thing I would further like to comment on is wage growth. And something else we look at is the Atlanta Fed wage tracker, which is running at 3.9%. That's a concern for us. If it starts getting in the 4% range, I think we'll give the Fed a little more ammo to act. As far as the overall bond market, our range of the 10-year Treasury, we're looking at somewhere 2.25 to 2.75. We're right in that range, so we haven't broke out of the range. Pretty comfortable with that. I think in December, though, the yield curve was telling us sentiment had gotten a little too far too fast. 10-year Treasury is up at 2.65. We've retraced all the way back to 2.35. So the yield curve was saying, as a sort of a leading indicator, maybe a little too much positive sentiment.
Yeah. Talk to me about where you think the economy is going. Because from my point of view, there has been smack talk on all sides, right? I mean, you look at inside the administration, Steve Mnuchin, they're talking about 3-4% growth. You have people like Larry Kudlow and others talking 4 and 5% growth, Steve Moore. The flip side of that, all of Wall Street was saying, watch out for Donald Trump. We're going to see the economy crash. He's going to start a trade war. Now it's time to really put your money on the table and make your bet. What do you think?
You know what? We've got some interesting variables, right? We've got headwinds from a very strong dollar. So even though we've had strong U.S. GDP growth, we have a ridiculously strong dollar, even relative to where we were 2 months ago, which is a headwind. But we do have a positive sentiment in the economy. We do have positive consumer sentiment. We also have the potential for massive fiscal stimulus and infrastructure spending. So all of these can be, boosts, but we have a slow global picture too, which we haven't had necessarily in, past environments. So it's difficult for the U.S. economy to pull away to that 4 or 5% by itself, and in the face of a strong dollar, when you really have weakness overseas. It's not necessarily as rosy a picture, but it's not a bad picture.
David, is the Fed behind? Is the Fed just right, or is the Fed ahead of where the economy is in your mind?
Yeah, I would say that 2 things I look at is Fed fund futures say the Fed will move twice in the next year, maybe June, end of the year. Dot plot is
we should explain to viewers that a year ago the Fed funds model was saying that they were going to go 3 or 4 in 2016 and ultimately went 1.
Correct. Obviously they threw other things into their consideration, international developments, the risk markets. The dot plot saying 3. A lot of things are priced to perfection. The dollar is priced to perfection. Since February, the dollar's up 10%.
You heard me say that on the show last week, probably.
Price at 10%. We like the dollar. We like dollar assets, but we hedged our bet coming into February. We did some of the large commodity-based currencies, Brazil, Russia, to sort of hedge that bet. Those currencies are up anywhere from 13 to 22%. As far as the Fed behind the curve, I think they're in the right place at the right time. I think that data dependency is one thing, but they're also going to look at markets And I think they've done that last year where they sort of pulled back from the numbers that came out and said, all right, the markets aren't reacting positively. We have to sort of take a deep breath and wait.
Yeah. What do you think? You think three moves?
I think that makes perfect sense. I think what's really interesting is that the 2 weeks after the election basically did what the Fed couldn't do in 4 or 5 years.
Yeah.
Couldn't change sentiment. Look at
Isn't that interesting?
Look at inflation expectations, right? The move in tips break-evens in the week following the elections was dramatic by any historical measure, and so it gave the Fed a much clearer path to keep raising rates because they don't have that uncertainty they had at the beginning of 2016.
Isn't that an argument that the government can't really control the economy the way they'd like to? I mean, he said it. We saw in those weeks after the election what the government couldn't do in all that time, what the Fed couldn't do. What do you think?
To me, it was keep rates at emergency levels for a long time, accumulate massive assets. If you look at the 3 central banks, they accumulated $27 trillion worth of assets with no exit strategy. Sort of was, to me, it was the central bank Ponzi scheme. You know, when is this going to end? How are we going to get out of this? There was no strategy to get out. So for me, it was a lot of uncertainty in the market.
Yeah, you guys are so smart.
Well, you know what? We're going to talk about how we make money in the bond market because a lot of people say you can't make money in the bond market anymore. These guys are going to tell us how we can right after the break. So guys, stay right there. Wall Street Week, we'll be right back.